welcome to the Sloth Investor podcast with your host, Mr. Sloth.
Welcome to the fourth episode of the Sloth Investor podcast, an investing podcast in which you'll learn why I believe the humble sloth is the best animal to characterize successful investing. Today's theme is the fourth bedrock principle of the Sloth Investor, and it's time. Jay, how are you feeling this week? Are you ready?
I'm feeling excited. I'm feeling jazzed. And I'm super stoked about our fourth episode.
Things are going well. We're settling into a groove, having a nice time. No pun intended with today's podcast theme, but things seem to be going well. We've had some lovely feedback on Twitter, via email, through colleagues that we work with. And we've certainly settled into quite the groove, haven't we? So things are going well now, fourth week.
It's great to see all the questions coming in and to see your audience build and as the audience builds, more questions come in, which is sort of a great loop to be part of and to be seeing happening as the Sloth Investor continues to grow his presence on Twitter.
Absolutely, that's so important. It's a really good point. It's so enjoyable to see this kind of interactive process taking place where we have people asking, hey, could you touch upon this in your episode on Own the World? And hey, I listened to your episode on low fees and you made a really good point about this. Could you shed a little bit more light on that on Twitter? So that kind of interactive engagement that is occurring as a result of these podcasts has been really pleasing to see. So yeah, long may it continue as well, for sure.
What I really actually would, as someone who sort of considers himself to be quite a noob, I enjoy about it because it's a community. We're all learning together. We're all finding and fumbling our way through this together. And hopefully along the process, we're saving ourselves some money in fees.
Absolutely. I mean, that's the key thing, Jay, isn't it? I mean, you make an excellent point there about learning from each other. I mean, there's a great quote I read a while ago. I think it's from Charlie Munger, Warren Buffett's, sideman, if you like. And he makes that great quote about learning from others, learning about what other people have to say, really encapsulating the key principles and essence of great thinkers from around the world. And that's something that I think we try to do. So during this podcast, we share quotes, we share extracts from books, and it's something that is really, really important to us. We want to learn from others. We want to kind of stand on the shoulders of giants, again, to use that Isaac Newton quote that I've used in previous podcast episodes, but it's so important. And ultimately, we want to be able to invest for the long term and gradually grow our wealth to the benefit of ourselves and our families, of course.
To get us rolling, perhaps into our fourth episode, do you mind if I bring us back to, and we've mentioned it in previous podcasts, the idea of FAANG, F-A-A-N-G. Now this, I believe it was Kramer who made this term popular, and if I understand correctly, it stands for Facebook, Apple, Amazon, Netflix, and Google. I've heard some people say, including yourself, that investing with FAANG can be a blessing and a curse. And I'm one of those people who was lucky enough to invest in FAANG starting about 4 or 5 years ago. And maybe you could touch upon a bit more about how that might be a blessing and a curse for an investor.
Yeah, absolutely, Jess. A really good point. So, anyone who's been following investing for the last 10 to 15 years will have seen that these stocks, FAANG, as you quite rightly say, Facebook, Amazon, Apple, Netflix, Google. I mean, these companies have been so great to own over that duration, okay, and perhaps even before. If you'd patiently owned these stocks, you would have done tremendously well. You really would. But, there's a bit of a paradox here for me because one thing that I think is really important to consider is the extent to which these companies have conditioned us to immediate gratification. Again, so how they have conditioned human beings to immediate gratification. Okay, so in essence, we become accustomed to getting what we want as soon as we want it. So I was just speaking to my wife the other day about this. So I don't know if you're a Friends fan, Jay, but my wife growing up, she loved Friends. As a teenager, she'd watch every episode.
I just watched the reunion a couple of weeks ago.
Was it good? I haven't watched it yet. Is it good?
Yeah, actually, I have to admit, I didn't have high hopes for it, and I was actually impressed with it.
My wife will be envious of you when she hears this show. She really will. Well, the thing for my wife was this. She loved Friends, but where she grew up, it was just a case of one episode per week. So perhaps it was a Friday night. She'd patiently wait all week for that Friends episode, and then it'll be over, and then, okay, she has to wait another seven days. And of course, for us now, oh my gosh, we are spoiled. We have Netflix, okay? We can instantly binge watch our favorite show.
The entire season.
Absolutely.
So in North America, it was Thursday nights. It was Seinfeld followed by Friends. So it came on every Thursday night. Everybody gathered in the common room to watch these two star shows.
Yeah, communal experience, right? So when I think about that, there's Netflix. I think about Amazon, the fact that pretty much we can get what we want in a short period of time, so, pretty quick indeed. I think about Uber, okay? We no longer have to wait around for a taxi. Instantly, within minutes, an Uber car will arrive. I think about so many aspects of our modern world, a Google search, no longer do we have to kind of look through, a series of books to locate information. We can Google it, of course. So we can think of so many more scenarios. But while this is great, I do wonder if this has been somewhat of a curse to the modern investor, because we now, as I've mentioned before, have become conditioned to immediate gratification. And of course, you and I both know that something that we really need in terms of investing, something that's so utterly important, is patience. Okay, so I'm going to quote now from Brian Portnoy. He's the author of The Geometry of Wealth. And he's got this great quote that I'd love to share with listeners now, okay? Begin quote. "One of the greatest skills in investing is patience, the Stoic ability to do nothing deliberately. In our money lives and well beyond, those who have mastered the art of delayed gratification are more likely to excel." End quote. So I do wonder, to what extent, contemporary technology, these companies, Facebook, Apple, Amazon, Netflix, Google, what are they doing to us in terms of our ability to be patient over time, to accept that Stoic ability to do nothing deliberately, to use Brian Portnoy's phrase. And I do wonder about, I really do. Speaking of Netflix, Jay, there's a great special I saw a few years ago by a Malaysian comedian, Ronnie Cheng. Have you seen it?
Oh my gosh, I find him absolutely hysterical.
I love him. I'm a big fan of Ronnie. And it was actually Christmas time a few years ago. I watched this special, and he had this great riff, this great commentary on Amazon. And I'm going to quote it. It's actually quite funny. Do you mind if I quote it now, Jay? I'm going to quote it. So,
please go ahead.
So he talks about this. He's talking here about Amazon Prime. Begin quote. Okay. He said, "I'm not as funny or hysterical as Ronnie, but I'll try my best to. We need it. Prime. We need Prime. Harder, faster, stronger. Faster Prime. Prime now. Prime now. 2-hour delivery. Prime now. Give it to me now. When I press buy, put the item in my hand now." And end quote. I love that. I mean, for me, it speaks.
That on demand.
On demand. We are living in an on-demand society, this instification of society. In some respects, it's so cool. We are spoiled. We really are in the 21st century, 2021. But on the other hand, it does make me wonder, what are we doing to ourselves in terms of our ability to sit and be patient? Maybe I'm overthinking this. Maybe it's me worrying. But it does make me wonder to what extent all of these kind of, modern conveniences that we've become accustomed to has eroded our ability to be patient. I don't know. What are your thoughts, Jay?
Can I give you a story that sort of loans itself perhaps to what you're describing? When I first when I first discovered that I was locked into one of those sort of sharks in a suit investment schemes, and I met with an investor friend, oddly enough, by the name of Ronnie. And so Ronnie took me out for a dinner. He's like, "Look, bring your contract, bring all your stuff. We'll take a look at it." And I think I've mentioned in a previous podcast, he said, "Well, I've read through the contract. Well, legally allowable, morally, what he's done to you is reprehensible." And I'll never forget that. But then he started to guide me, and he said, "Look, this is probably about 6 years ago." He said, "We're going to get you out of this contract. You're going to pay the penalties. You're going to leave it and forget about it. Put it behind you. We need to move past this. You can't look back." And he said, "You're going to invest in, you're going to take that money that you have, you're going to invest in Google, you're going to invest in Amazon, you're going to invest in Facebook, and actually Apple as well." He left out Netflix. He wasn't so quite sure, so quite keen on Netflix. But for those sort of those 4 pillars for me, those grew so fast and so quick. And I kind of looked at my other stocks, and when I would do some investing, I was like, well, wait a second. Why aren't these other stocks growing at 60-70% a year? How come they're so slow? And I had to learn a couple hard lessons along the way that not all stocks grow at that rate, and I need to make sure I'm patient and spending time in the market and not expecting that instant gratification in an investment. And I think back to sort of my investment. I've full disclosure, I've parked some money in GM. And initially when I put some money in GM, the stock went down. And it went down maybe for about a month or two. And I'm happy to say that after learning some hard lessons, I just kicked back. I believed in the company and my research and what I had found out and what I had read and what I had heard. And I sat back, and I'm happy to say now that I'm in a position now where it's paid off quite well for me. But that has to come back to that idea that if I been seeking that immediate gratification, that immediate bump in my share price, I would have bailed out and been sort of lamenting the fact that it hadn't gone up as fast as I expected it because of FAANG.
Yeah, that's a good point. I mean, I think it was Peter Lynch, actually, that famed investor, who also mentioned that fact that it may well be that the best returns you get aren't necessarily in your first year or your second year. It's often the case it may be your third or fourth year indeed that those returns really come through. So again, it's just about being patient. And I love the example you give about GM, because yes, we can see that there are companies that immediately it seems are going to do really well, and you can see those those stocks really fly up higher, and you kind of start to get a bit complacent. You think, well, why isn't every company performing like this? But again, it's just having that measured understanding that every company is unique, and it may not be that you get those immediate results that you did, obviously, with those Facebook, Amazon, Google, and so on. So it's just about being patient. If you've done your due diligence, just seeing a story play out. So yeah, it's so critically important to have that long-term mindset and to be patient.
You had told me a story once about Grace Grommer. Can you? I think this would be a good time for you to share that with our audience.
Yeah. So
a remarkable story.
It is. It is. It really is. So anyone that knows me well and has spoken to me about investing knows that I'm a big fan of Morgan Housel. And Morgan has, within the last few years, released a great book called The Psychology of Money. But in June 2018, he actually released an article online with the same name, The Psychology of Money. And within this article, he talks at length about a really interesting individual. So it's Grace Groner. And to give you a bit of a background about her short bio, she was born in 1909 in the US. She was orphaned at the age of 12. She never married. She never had kids. And she lived in a one-bedroom house. And she worked her whole career as a secretary. Now, it seems like, this is someone who's perhaps lived quite an unremarkable life, nothing out of the ordinary, what's there to talk about. But what's interesting is that when she died in 2010, she actually left $7 million to a nearby college, named the Lake Forest College. And this money was to be used for scholarships. Now, our listeners may now be wondering, well, how on earth did Grace Groner accumulate such wealth? You mentioned the fact that she worked her whole career as a secretary. She never married. And how did this come about? Well, to give you a bit of insight, so she worked for 43 years for Abbott Laboratories. And she initially, in the 1930s, bought a few shares. And then throughout her career there at Abbott Laboratories, she bought more shares and more shares. And she kept reinvesting the dividends. And she never sold a share. And by the time of her death, it was clear that she had over 100,000 shares valued at $7 million. Now, there's a few key points I want to make here. So I do want to talk about only investing in one company and the dangers of that. So I'm definitely going to park that just for a moment. And I will certainly come back to that. But the key point I really do want to make is this, and that's the fact that she never sold a single share. And you just think about all of those geopolitical events that took place during the time when she was alive. I think about, obviously, World War II, a major event. In the 50s, there's the Korean War. In the 60s, you've got the Cuban Missile Crisis, JFK's assassination, the Vietnam War. In the 70s, the oil crisis.
Yes.
And I could go on, okay? But you think about all of those decades, those key geopolitical events that took place during her lifetime, and yet what did she do? She, quite simply, possessed that stoic ability that I spoke about before, that stoic ability to do nothing deliberately. And that's what she did. So I mean, that for me is a key lesson, okay? Remain invested. Don't be put off by the geopolitical events of the day, whether it's a war, whether it's an oil crisis, whether it's a pandemic, for example, okay? Very apt right now what we're going through, okay? But just to remain invested, it really is important. And I will, I want to hand back to you and your thoughts, but I'll definitely touch upon as well what she did in terms of investing in one company. Let me pass on to you, Jay.
Well, and it reminds me, I remember watching a segment with Warren Buffett, an interview with Warren Buffett, and he highlights exactly what you were speaking about. If you had invested just after the World War II, and what they found is the people who had forgot about their investments, people who had just left their investments behind, actually outperformed the active investment managers because they had just left it and let it ride. And 30, 40 years on, their investments were worth, and as the case of, and I'm just looking on Amazon, it's called Never Sell Investing. There's a book, and it seems to be about Grace Cromer.
Wow.
And this situation, yeah.
That's news to me.
Yeah, so okay. It's for anybody who might be interested in looking up, it's called Never Sell Investing by R.M. Thompson.
Fantastic.
And so it to me, it speaks to the importance of making sure that when you do your due diligence, that you stick to your guns.
Yeah.
Provided that you believe in that company.
Absolutely. Absolutely. It's so important just to remain invested throughout the geopolitical events. Don't be put off by what's taking place, in the outside world, and to be headstrong, which obviously would touch a lot more upon it in next week's podcast, the 5th bedrock principle. But I do want to circle back to what Grace did. Okay, so it's important that we take away the right lesson from Grace's story. So absolutely, Grace, what she did was to stick to her guns, to ignore the noise, to shut out the noise of the market, ignore the sensationalism of the headlines that inevitably would have occurred with those geopolitical events that we've touched upon before. However, absolutely, we cannot deny the fact that what she also did, is very risky. It was a great danger, And, I've got a quote here from David Roeder of the Chicago Sun-Times. This is quoted in a Wall Street Journal article about Grace. And I'm going to begin the quote now. So here's David Roeder, begin quote. "It is a grave error to put your nest egg behind a single company. Groner had a winner, but others may have done this with Enron," end quote. So it's really important that we have that nuanced perspective on what Grace did. Yes, absolutely. Full credit to her for, remaining invested for multiple decades, 5, 6, 7 decades. It's great what she did. She ignored the noise out of the outside world, those geopolitical events that I've mentioned several times now. But ultimately, Jay, would you and I see that as a good investment approach to invest all of your nest egg, all of your savings, your income into one particular company? What are your thoughts on that?
No, absolutely. And the importance, it's funny because I remember mentioning to a friend, I said, I don't think that this company it's a can't lose investment. And one of my friends said the guy at Kodak. And, there's a perfect example. At one point, they ruled the world. In the 80s and 90s, they were the big investment company. Nortel is another good example in Canada. BlackBerry, another good example. These companies at one point in time had sort of their time in the sun. They were reigning supreme. And had you only invested in that one company, then your investment would have been leveled. If you have a diversified portfolio that includes some giants like Kodak or BlackBerry, then you're well protected.
So diversification is so important, okay? And if anybody wants to get a bit of a deeper insight into diversification and what we believe about global diversification, then please do listen to episode 3, okay? That was last week's podcast on owning the world. Yeah, really, really important.
I have the word on my whiteboard here written, tyranny of the calendar. Talk to our listeners about tyranny of the calendar.
Thanks, Jay. Yeah, so again, I'm going to circle back to Morgan Housel here. He's written so many great things about time and the importance of committing to time in the market. Okay, so in September 2015, he released an article entitled Tyranny of the Calendar, and it's a really, really great article, and it speaks so much about really our obsession, our relentless focus on 1 year returns. So invariably, if you were looking, for example, at a fund fact sheet, or if you're looking at the performance of a particular company, the performance of its stock, invariably you're going to see the 1 year performance, whether you're looking at Yahoo Finance or Google Finance.
I do that.
Yeah, absolutely. We're all guilty of it. Okay. But Housel makes a great point about our relentless focus. Why is it we do this? So I'm going to quote him here. Okay. So this is what Morgan Housel has to say about the tyranny of the calendar and our obsession, our fascination with those 1 year returns. Okay. Begin quote. You should expect year-to-year stability in investing returns if there is something special about a year, but there's not. All that matters is performance between today and your end goal, not the individual years in between. So Housel makes a good point here about our relentless obsession with always wanting to use the 1 year return as a yardstick, okay? And it's dangerous. It really is dangerous because you can see how quite easily it could deter certain people from investing. I mean, imagine there's someone who's about to begin their investing journey and they take a look, for example, at the 1 year return of maybe a low fee, broadly diversified ETF, index fund, okay? And they think to themselves, well, I've listened to the Sloth Investor podcast and I've followed him on Twitter and I really, really want a hands-off approach to investing, but in this particularly, I've taken a look at the 12-month return and it's not particularly great, okay? And it's kind of deterred me from investing. So Jay, what would you say to someone like that in that scenario?
Yeah, and what would I say? I would probably say that can't be your benchmark. That your due diligence on investing in a company can't come from looking at a line chart on the 6 month or 1 year return. And I wonder, is the opposite, the inverse true, where you're like, oh, it's at a 52-week high. I'm not going to buy right now because it's at a 52-week or 3 year high. So I'm going to wait till it cools off. And good companies are continually setting 52-week highs.
Yeah. I mean, it's so true. One of my favorite investing books is The Motley Fool Investment Guide by David and Tom Gardner, the founders of The Motley Fool, and they make that very point in the book. It's the third edition. They write, quite simply that winners keep winning, so there's that temptation to think that, well, this company has risen 50% in the last 12 months, maybe even 50% in the last 6 months. Oh, should I really invest? Okay. So, there's multiple factors to consider in that scenario. I'm not saying to listeners you should immediately go out and buy it because, winners will always keep winning. But it's certainly the case that there are companies that have that competitive moat. They have that strength in their particular landscape, and there's a good chance that they may very well keep on winning. So David Gardner and Tom Gardner are really key advocates of that approach that, invariably, winners keep winning. It's really, really important to consider.
I like that phrase, actually. I had forgotten about that till you just mentioned it. And the same, I think, can be said for something like Google or Amazon or Apple or nowadays, Microsoft seems to be sort of the one that the big tech giant that everybody wants to own.
And something a phrase that really keeps coming to my mind in the last few years is optionality. And I just think about these companies that you mentioned. I think about Apple and Google and Facebook and the acquisitions they've made in the last 10 years. You look at Google when they acquired YouTube, what a great move that was. You look at Facebook when they acquired Instagram. Just this optionality, winners keep winning, okay? And we can see clearly that it would be dangerous to immediately think, well, this company's risen so much in the last 2, 3, 4 years. Do your due diligence, but if you can see that a company is continuing to acquire companies, continue to expand, if the optionality is still in play, there's a good chance that that particular company will continue to do well. So to circle back to Housel's point, yeah, the relentless focus on 1 year returns is something that is it's something that individual investors can be inclined to rely upon too much, and it's just really important to zoom out and to focus upon that broader, longer term picture.
Now, as an investor, let's say I'm getting up there in age, I'm getting close to retirement, and my stocks have done really, really well. What happens when I retire? Do I cash out everything, or do I keep some in the market? Do I keep all of it in the market? What would be your advice to an investor who is retiring and they holding their portfolio? What do you think you would suggest they do?
Yeah, I mean, there's often this danger of thinking about the fact that, well, I'm approaching retirement, I'm about to retire, so I'm going to pull everything out of the stock market. Okay, I've retired at say 65 years old. That's it for me in terms of investing. I'm pulling everything out. But really, I'm going to quote Andrew Hallam now, who's the author of The Millionaire Teacher, and he's a real favorite of ours. We mentioned him, in previous episodes. And I'm going to quote from him now from a 2019 article that he wrote for Swiss Quote, and it's entitled "The Biggest Challenge That Investors Face in These Uncertain Times." Okay, and this is what he has to say about this very issue. Begin quote. "Nor should investors focus on a single year's return. In fact, they shouldn't pay attention to a single decade either. Your investment duration, after all, spans beyond your working lifetime. It spans as long as you'll be living." End quote. Okay, so this is a really important point he makes there. You just think about the danger of potentially withdrawing all of your money at retirement, and then you just think about your money not really working for you. There's money that you've got there sitting in the bank. It's not working for you, which it's a real shame. It could be, okay? Perhaps in another show we can go into more detail as well about the role that bonds can play in acting as kind of a portfolio parachute. That's a really deep mine hole that we could go down into for sure. But that's also certainly a consideration as well, the role of bonds and what we can do in terms of reflecting upon our age and the percentage that we want in bonds. But I think that'll have to be for another show because that's a real mindful that we can go down. But the key point I think that we really want to stress here is to think about, well, you retire and you don't necessarily have to withdraw all of your money at retirement.
Now, you mentioned stocks and bonds. Those are the traditional ways of to invest your money. Bitcoin comes to mind. And I, for one, am reticent to invest in Bitcoin. I'm reluctant. I have some trepidation. I can't figure out what sends it higher or lower other than Elon Musk having a tweet about them. I find that like gambling. I find Bitcoin to be like gambling. For the newbie investor, and I've had some people tell me, well, the stock market's a lot like gambling. Would you say investing in stocks, can you compare that to gambling as well?
That's a really good question, Jay. So, so a common criticism of investing, often uttered by the layperson, is that investing is nothing more than a form of gambling. Okay, so it's important to note that any comparison between investing and gambling, in my opinion, is misjudged. Okay, so this is because it fails to take into account the key dimension of time, the theme of today's podcast episode. All right, so the short-term performance of the stock market, particularly over, say, a 1-year period, can be less predictable. Okay, so we spoke about that with that Morgan Housel reference, the tyranny of the calendar. All right, so I would argue, and I'd humbly admit that investing money that you'll need 12 months later certainly is a form of gambling. Okay, so if you're investing money and you need that money 12 months later, yeah, absolutely, that would be a form of gambling. However, by looking at the long-term, multi-decade returns to the stock market, we can see that the returns are more consistently, overwhelmingly positive than if one were to simply look at returns over a 1-year period only. So I'm talking about the broader stock market here. Okay, so I would argue that investing money that you won't need for at least another decade, while not entirely without risk, carries with it less similarity to gambling. So essentially, when you enter a casino, the house is always expected to win over the long run on average. However, when it comes to investing, the longer you remain invested, the more likely it is that the eventual outcome will be positive. Okay, so my final point here is to say that if any form of capital allocation were to provide us with a greater resemblance to gambling, then I would argue that it's trading. But remember, the sloth investor does not trade, the sloth investor invests, i.e. I invest, and I know you invest, Jay, with a long-term time horizon.
You know what? It makes me think about when I first moved over here, just after the handover in Hong Kong. It was 1997, and the stock market was something very new to me. My dad was actually a financial planner back in Canada, and he was always mutual funds, mutual funds, mutual funds. And that was what I thought I should be doing. So I went to the bank, and trusting the bank, I actually had parked a lot of my savings in mutual funds. Then shortly after that, about a year after that, there was a big stock market correction. And being a noob, I sold. I thought like, oh crap, this is bad times. I'm going to get my money back while I can. Had I left my money in there, I probably wouldn't have to work right now.
Yeah.
If I had just kept on buying through the dips and doodles, the 20 years, that's a good lifetime for an investment. And the return you're likely to see on a well-balanced, a well-placed ETF or stock is going to be quite substantial. That's what I guess my hope is, that people can learn from my lessons, that they can sort of take away about the mistakes, not to avoid the same mistakes and pitfalls that I've made.
And you make a really good point there about the media, okay, and about the role that can play in terms of how it can cause us to really overreact and overthink and kind of deter us from adhering to a long-term mindset, essentially. Okay, so we think about...
They steer us off course.
Yeah, absolutely. It really does steer us off course. And you think about things, how the media has developed in the last 15 years. We think about the growth of social media and smartphones. And Jeff Bezos uses this great phrase in one of his shareholder letters, information snacking, and our contemporary inclination to information snack. Okay. And that can lead us to start to overthink. And we read this headline, we watch this news bulletin on CNBC. We see the neon lights that I've spoken before from the trading floor, the New York Stock Exchange, the furrowed brows and the kind of the beads of sweat trickling down the forehead of the traders on the trading floor there over in New York. And it really can compel us to think, well, wow, perhaps I need to act, I need to do something because this is worrying. Okay, this is not something that I want to cope with. And it really can deter us off our course. Okay, and it's actually a great tweet that I read recently from someone online from the FinTwit community, and it's this is from Growth to Value. Okay, and the account is @FromValue, and I'll put a link to that. I'll put a link to his Twitter account in the description for this podcast episode. But this is what he says, and in particular with regards to stock price drops. So what we should do in terms of stock price drops, and these are his 3 mantras. So number 1, zoom out. Number 2, to think this too shall pass. And number 3, time is your friend. And I love that. I love those 3 mantras. I think it's so important, okay? We even think about, Jay, the volatility that we saw in the market earlier this year. That's let alone thinking about the volatility last year when the pandemic really started to kind of, emerge in such a significant way was paramount. And I'm thinking back to March 2020 when things were looking really scary. It could have been really easy for investors to pull all of their money out of the stock market, but those who remained long and headstrong, a phrase that I use repeatedly on Twitter, were rewarded, okay? Just by being patient, committing to that long-term mindset, time view. It's really important to do that, to be patient, to ignore the noise, just like Grace Groener did for all those multiple decades that she invested for. It's really, really important to do that.
Can I add a sort of a bit? Again, it's even though I know all these things, I still make what should be rookie mistakes. And when the pandemic first hit, the stock market, maybe about 14 months ago, I started in my head, to play out what's going to happen to the banks. And I thought, my bank stocks, I need to sell. I need to try and recoup some money in my bank stocks. And that was proved to be a hideous mistake now, because had I had the time in the market and just this too shall pass mindset, I would have been much further ahead of the game. I sold at a minimal gain, whereas right now, had I just kept my money there and stopped thinking about the sensationalism and the headlines and that this too shall pass mindset, my investments would be paying off a lot in a lot greater amount.
Yeah, that's a great point. And something that I think we're going to touch upon a lot next week in our 5th episode, which will, of course, be based upon the 5th bedrock principle, the Sloth Investor, that's being headstrong, is the biases. Okay, so it's those cognitive biases that can affect us all. Okay, so you make a really good point there, okay, about just how easy it is for us to be affected by the sensation and the news headlines.
You get caught up in it.
You really do. You really do. And the best thing to do is to switch off, go and have a chat with your family, a family member, take a walk, go and do some exercise, listen to music, just turn off CNBC, don't read the financial news, and just stay the course and just keep investing, keep that stoic ability to do nothing deliberately. I'm coming back to that Brian Portnoy phrase yet again from the Geometry of Wealth. And again, I'll link to that book within the description for this podcast episode.
All right, everybody. Thanks very much for tuning in. Wait a second. Before we go, I know that our host has been dying to share 2 quotes with you that he has, and I want to make sure that we get to those. Mr. Sloth Investor, please, what are these 2 quotes? Because I know you've been saving these up, and I can see the smile in your face, and I can see the sort of the excitement in your energy in your aura that you want to be able to share these 2 quotes.
Jay, you know me by now. We're 4 episodes in. I love a quote. My wife knows that. My kids know. Jay, you know it by now. 4 episodes in. I love a good quote. And when it comes to investment quotes, when it comes to time, oh my goodness, they're just too many to choose from. They're too many. But I'm going to pick out 2 that I absolutely love. Okay, so quote number 1 is by Charlie Munger. Okay, and this is a great quote.
Charlie Munger works with Berkshire.
Yeah, Warren Buffett. Warren Buffett's partner in crime, if you like. And let me share this quote with you now from Charlie Munger. Okay, begin quote: "The big money is not in the buying and selling, but in the waiting." End quote. I love that. I love that. And this is another quote by Jesse Livermore. And again, a fantastic quote. And it resonates so deeply with me. And it really touches upon so many of the themes that we've explored today with regards to time in the market. Okay, so this is from Jesse Livermore. Begin quote: "It was never my thinking that made the big money for me. It always was my sitting." Got that? My sitting tight. End quote. And Jay, you know, I mentioned a moment ago that when things get a little bit hairy in the stock market, when the financial news is full of sensationalism, I just like to switch off the TV and listen to a bit of music. And I'm a big fan of the Beatles and the Rolling Stones. Anyone that knows me will know I'm a big fan of the Beatles and the Stones. And there's 2 songs.
You have to be. You're from UK.
I'm from the UK, and it's part of the. It's a rite of passage. It's part of my DNA. You know, I have to love football or soccer for North American friends, and I have to love the Beatles and the Stones. And when I think about an album I was listening to just a few days ago, Let It Be. Okay, great song on there. The Long and Winding Road. I mean, that has got such a great connection to investing. The Long and Winding Road. And it's a Rolling Stones song up next. To be fair, it's not one of my favorite Rolling Stones songs, but again, it has so much relevance to investing. And the title is Time Is On My Side. Okay, Time Is On My Side. Again, a song that I think really, really connects well to that long-term mindset. Okay, adopting a long-term view of investing in the stock market.
Yeah, and to me, that's a great way for us to finish that. Time is on your side. Keep your head. Don't lose your cool when you watch the headlines. And I liked your advice that the biggest thing you can do is just turn the TV off. If you've liked the investment, take a step back from it, because it will. My experience and my research has shown me that it does pay off.
Absolutely.
To take that step back.
Absolutely.
All right, everybody. Thanks for tuning in to another episode. And next week we will be having episode 5.
Absolutely. Episode 5 about the 5th bedrock principle of the Sloth Investor, the ability to be headstrong. And you know, there are so many connections to time as well. So I really love the way that kind of time, the 4th bedrock principle, and headstrong, the 5th bedrock principle, they are really so connected to each other. They really are. So you'll learn more about that in next week's episode.
Thanks for tuning in, everybody. And we'll see you next week.
So long. Bye for now.
For
more tips, follow the Sloth Investor on Twitter at Sloth_Investor.